Welcome back to Investing Talk Podcast. The focus today is on Better Home and Finance, a company really causing some massive whiplash in the markets right now. We're asking the core question for you, the listener. Is Better Home and Finance a good time to buy now? We've got a stack of sources here detailing just wild price swings, huge speculative claims, but also some deeply concerning financial results. Our mission is really to unpack whether this highly volatile online mortgage originator presents a true high-growth opportunity, or if it's more of a financial trap. And as always, we love to hear what you are watching. If you want us to look into a specific company, please leave a comment below. Also, hit that subscribe button, like, and share. It really helps us out.
Yeah, we absolutely have to analyze this one today because the conflict in these sources is just, it's stark. I mean, on one side, you've got a prominent hedge fund manager predicting, what was it, a 350-bagger return?
Yeah, incredible numbers being thrown around.
And then, on the other side, you have the company's own auditors raising substantial doubt about its ability to continue as a going concern. So this isn't just your typical bull versus bear thing. It's really a question of whether the company fundamentally survives long enough to even try to execute that growth story.
That really does set the stakes incredibly high. Let's start with the ignition point then. The massive price action that got everyone talking. The stock surged, what was it, nearly 47%. In a single day.
That's right, a Monday surge, fueled pretty much entirely by a single high-profile bullish call. That catalyst was hedge fund manager Eric Jackson of EMJ Capital. He went long and immediately started calling Better Home and Finance the Shopify of mortgages.
The Shopify of mortgages.
Yeah, claiming it's using AI to rebuild the entire $15 trillion mortgage industry. It's a huge disruptive claim.
It is. And I kind of have to challenge that analogy right off the bat. I mean, Shopify enables commerce.
Right.
It doesn't hold the liability of credit risk itself. Isn't that comparison maybe fundamentally flawed? Because Better Home and Finance is deeply tied to the volatility of housing and credit markets.
Well, that's the critical distinction, isn't it? Jackson's whole thesis seems to be that the technology is so efficient at origination that it essentially de-risks the process, or at least the origination part, and allows them to scale without the usual, legacy costs. So if the technology works as advertised, it potentially turns a high-risk, liability-heavy business into more of a high-margin tech platform.
Okay, so he's betting on the platform efficiency, not necessarily the strength of the current balance sheet.
Exactly. Not yet, anyway. He's betting on the transformation.
And his prediction definitely aligns with that explosive potential. He sees it as a potential 350-bagger in 2 years. A price target of $12,000 per share. I mean, that figure just sounds almost fantastical.
It does, but what's fascinating looking at the sources is Jackson's track record. He has called some explosive growth stories before. He was bullish on Opendoor, which, wow, rallied over 424% year to date.
Right.
And he was an early advocate for Carvana, remember, when it was trading way down near its lows. So his argument now is, people are laughing now at Better Home and Finance, just like they apparently laughed at those previous calls before they surged.
Okay, so there's precedent for him identifying these kinds of turnarounds or disruptions. And to back that up, he pointed out a valuation metric.
Yeah, a key discrepancy he highlighted. The company currently trades at a valuation multiple of just 1x their projected 2026 sales.
1 times future sales.
Right. And he contrasts that sharply with a comparable blockchain lender, Figure Technology Solutions, which apparently trades at 19x sales. So the argument is pretty simple. If Better Home and Finance hits those growth numbers Jackson expects, then it's massively undervalued right now compared to peers.
That tech narrative, it sounds compelling on paper. But let's zoom out a bit. If we look at the actual operations, the profit lines, is any of this AI efficiency actually translating to the bottom line yet? Or are they just losing money faster while they grow?
Well, the growth is genuine. That part seems clear. They are taking market share. In Q2 2025, funded loan volume hit $1.2 billion. That's a pretty robust 25% year-over-year increase.
Okay, 25% jump in loan volume.
And revenues grew strongly, too. Q1 2025 net revenues were $32.6 million. That marks a solid 46% year-over-year growth. So, the volume, the top-line expansion, they're ticking the right boxes for a high-growth story, at least on the surface.
Let's focus on the tech itself, then, the AI that supposedly powers this. Yeah. You mentioned 2 key platforms.
That's right. The core bullish thesis really rests on these 2 AI platforms driving efficiency gains. First, there's Betsy. That's their customer engagement tool. Apparently, it handles about 115,000 interactions monthly, largely automating that initial customer contact.
Okay, Betsy for customers.
And then there's Tin Man, that's their underwriting system. The claim is it automates about 40% of loan reviews. The goal for both is obviously high volume, minimal human labor cost.
And we did see some evidence suggesting this blend, this hybrid model, might be working margin-wise. The NEO Powered by Better initiative, that's the one blending AI with local loan officers, it achieved higher margins.
Significantly higher. 365 basis points in margin compared to only 217 basis points for their, let's call them standard loans.
Right. So for listeners who maybe don't track basis points daily, what is that difference? 148 basis points, what does that actually mean for profitability per loan?
It essentially means that for every dollar they lend out using that AI-powered hybrid model, it's significantly more profitable than their traditional method. Roughly 70% more profitable per loan, actually.
70%? Yeah.
Yeah. And that is the core argument for scalable efficiency. If they can push more, ideally all of their volume through that hybrid AI channel, well, the profit margins could change dramatically.
And that's probably what fuels those really long-term speculative rumors that push this towards that 350 bagger idea.
Precisely. There are these unverified reports floating around that the company might be exploring an AI licensing strategy.
Selling Betsy and Tin Man.
Exactly, selling them to other institutions. One source we saw speculates this licensing alone could drive maybe $12 billion in revenue by 2028. Now, if that happens, you completely validate the Shopify of mortgages comparison, right? And the current valuation concerns kind of melt away.
Okay. That technology story, the massive potential, it's clear why there's hype. Now, let's completely flip the coin. Let's look at the financial reality. We're moving from the dream scenario to maybe the current balance sheet nightmare.
And this is exactly why the uncertainty rating on this stock is flagged as high. Because despite that impressive revenue growth, despite the tech gains, the company is deeply, deeply unprofitable. And crucially, its losses are actually widening.
Getting worse, not better.
Right. In Q2 2025, they reported an adjusted EBITDA loss of about $27 million. That was worse than the $23 million loss they reported the year before. They're essentially burning more cash now to achieve that high loan volume growth.
How does that reflect in their basic ability to survive? You mentioned a really staggering figure earlier. Normalized return on equity.
Yeah, it's deeply negative, negative 202.5%.
Minus 200% ROE. What does that actually signal?
Well, a negative 202.5% return on equity basically means the company is rapidly destroying shareholder capital. For every dollar of equity that investors theoretically own, the company is losing more than $2. It signals a severe inability to generate sustained value from its existing capital base. Honestly, this is the kind of financial indicator that should make any growth investor just pause and take a very deep breath.
And the balance sheet itself seems to back up this really dire assessment. Accumulated losses, the deficit, is nearly $2 billion.
Almost $2 billion accumulated deficit as of March 31st, 2025. And total stockholders' equity is negative $102.1 million.
So negative net worth. They owe more than they own in shareholder terms.
Correct. And when you look at the debt side, the risk just gets amplified. Their debt-to-equity ratio is extremely high, 15.09x. That signals a dangerously fragile financial structure.
Okay.
So it's this combination: persistent, widening losses, negative equity, high debt. That's why the company's annual filings had to include that warning, that phrase, substantial doubt about its ability to continue as a going concern.
Right. For listeners who maybe haven't encountered that specific phrase before in filings, what does a going concern warning actually mean in the real world for shareholders? What's the practical implication?
It's basically the most serious warning an auditor can issue without just flat out refusing to sign off on the financials. It means the accountants have looked at the cash burn rate, the liabilities, the assets, and they're stating that, based on current projections, there's a high risk the company might not be able to meet its financial obligations over the next 12 months, typically, so they might not be able to stay in business.
So Eric Jackson is essentially betting that the technology is so transformative, it can overcome a fundamental doubt about the company's very existence in the near term.
Exactly. It turns the stock into, well, almost a literal binary bet on survival. Does the tech win before the cash runs out?
And that stark disconnect, it's reflected in third-party analysis too, right? Morningstar.
Yeah, Morningstar stated the stock is currently trading at a, quote, staggering 378% premium to its calculated fair value.
378% premium.
They simply don't seem to believe the earnings potential, or at least the path to sustainable earnings, is there yet. Hence their extremely low fundamental risk rating for the stock 2 out of 10.
Okay. Given this intense conflict, the narrative versus the fundamentals, it makes sense. The stock is just a magnet for volatility.
Yeah.
We saw those trades swinging wildly between, what, $33 and $94 in August alone, just huge swings.
Incredible intraday volatility.
So what key volatility drivers should investors be watching, especially in the near term, say the next few months?
Right. Well, we have several critical dates coming up. The immediate focus has got to be the Q3 2025 earnings release. That's scheduled for October 24th.
Okay, late October. What's key there?
It's the first major test of two things, really. One, are they still achieving that strong loan volume growth? And two, maybe more importantly, are they showing any tangible progress towards managing costs, towards shrinking that EBITDA loss? Or is it still widening?
Got it. Growth versus burn rate, essentially.
Yes. And beyond earnings, you've got external market events that could drive movement. November 8th brings the major ETF quarterly rebalancing.
Index inclusion or exclusion?
Could be significant. And then December 5th is the publication date for institutional 13F filings. These releases will show us whether the big institutional funds are buying into the Jackson disruption thesis or if they're running scared from that going concern risk.
So big money moving in or out could cause waves.
Absolutely. Either action could cause significant price swings up or down.
And then we also have those high-impact speculative risks, the ones that revolve around capital, which seems to be the crux of the issue here.
Precisely. On the negative side, you have persistent market speculation about a possible secondary stock offering, an equity raise. Given the high cash burn, the liquidity concerns, the company almost certainly needs more capital eventually.
And a large stock offering would dilute existing shareholders.
Potentially dramatically, yes. That's the big risk hanging over the stock.
But then there's the flip side, the positive speculation. Acquisition rumors.
Yes, unverified, mind you, but rumors persist of acquisition approaches from potentially larger mortgage finance players. Now, these potential acquirers, they likely wouldn't be buying the messy balance sheet. They'd be drawn specifically to the technology platform Betsy and Tinman and maybe those impressive origination growth numbers.
So a classic acqui-hire or acquire the tech play.
Could be. And that would offer a potentially quick exit at a premium for existing shareholders, bypassing the whole going concern issue.
And we really mustn't forget the broader sector risks either. Even if Better Home and Finance executes perfectly on its AI strategy internally, they still operate in the wider mortgage environment. Rising interest rates, competitive pressure from established banks, other profitable fintechs.
Right. Those external factors could sharply curtail loan volumes or pressure margins, regardless of how efficient their internal AI becomes. They don't operate in a vacuum.
Okay, so let's try and synthesize this. What does this all mean for you, the listener, trying to decide on this stock? It really seems to present the ultimate high-risk, high-reward scenario. You've got this compelling, high-growth, tech-driven narrative championed by a known successful investor.
And on the other side, just a mountain of losses, negative equity, and that formal going concern warning from the auditors. It's a stark contrast. Look, the investment thesis for Better Home and Finance right now relies almost entirely on flawless execution and massive scalability of their AI technology. That's the bet. The current fundamentals simply do not support the current stock price based on traditional metrics. So the question for you, the investor, really boils down to, do you prioritize Eric Jackson's track record in spotting these huge market disruptions early, or do you focus on the stark, high-risk balance sheet and the analyst consensus saying the stock is wildly overvalued right now?
It really is a highly speculative, almost binary bet, as you said.
It is.
Okay, so given that high uncertainty rating and the really clear need for significant capital just to scale their AI and hybrid models without, well, going bankrupt, here's maybe a provocative thought to leave you with. Considering they already have an accumulated deficit closing in on $2 billion, what amount of new capital do you think it would take? Whether it comes from a speculative acquisition or a highly dilutive stock offering. What's the number needed just to stabilize the company enough to get that going concern warning lifted? To actually turn the narrative from just a growth story into something resembling a potentially profitable leader?
That's the stabilization number.
That's the stabilization number you might want to try and estimate before those Q3 earnings hit on October 24th. Something to really mull over.